Joining us for a closer look on what's playing itself out on that market scene is Louis Storm from Vega Capital. Louis, a pleasure. Good afternoon.
Hi, thank you for having me.
Fantastic, Louis. We do see markets reacting to inflation prints. US coming in hotter than expected. I think UK coming in at 4%. Let's talk about digesting this data.
Yeah, so the US rate cut expectations have pushed back due to the resilient economy and the January CPI number that was worse than expected. The reason that the US CPI exceeded expectations was because of service prices and housing costs. So the market is now actually pricing in interest rate cuts of 90 basis points, where the expectation at the end of 2023 was closer to 160 basis points. So this is obviously not great for the global economic growth, and that translates into a bit of a drawdown for the stocks and bonds.
I'm wondering if the US will ever see money as cheap as it was in the decades before we saw this inflation print. Now that we are pricing in a 90 basis point cut there, markets might just have to adjust to the fact that even though interest rates are cut, money will never be that cheap again.
Yeah, it would probably be a good thing if it's never that cheap again, because that would probably mean that we're in a recession. That's the only time where the US would probably cut rates to where it was. So I don't think it will go back to there if we do avoid a recession. So, but we will see some interest rate cuts, I'm sure of it. I think 90 basis points are much more in range of what the Fed is thinking. I thought 160 basis points was a bit excessive. So I think we are getting into that range now.
And then let's also talk on the rand. That seems to, of course, have struggled, and that's really based on dollar strength. We've seen the Treasury yields also reflecting a dollar strength there. And it's just us being price takers at this point.
That's correct. Obviously, load shedding is not helping either, but that's correct. So the US dollar strengthening obviously then weakens the rand. So as mentioned, that the interest rate cuts that is being priced in is obviously now at least 90 basis points. So that strengthened the US dollar and obviously putting pressure on the rand.
Also keen then to touch on how this plays into the commercial real estate sector, Louis, and if this is concentrated in any part of the world where, there is risk that we're seeing emerging there.
So the issue started when COVID came along and companies allowed employees to work from home. Companies then obviously realized they don't need all the office space, so they started leasing some of the office space or even selling some of the office space. So the risk now is obviously the demand for office space is very low, and there's a bunch of loans linked to the office space and to the value of that office space. But we don't see this as a systemic risk at the moment. This is very much focused on the smaller US banks holding around 40% of those loans. And of those 40% of the real estate or commercial real estate loans, only about 12% is the office focused on office loans. So at the moment, there's not a real risk, especially for the larger US banks. We don't see any risk, but for the smaller ones, there could be some volatility and some uncertainty in the next 6 months or so.
And with that said, the higher for longer interest rates haven't been able to assist that picture at all, have they?
Excuse me, just say that again.
I was asking if the higher for longer interest rates have also contributed to some of the strain that we're seeing there with the commercial real estate.
That's correct. That's correct. You're obviously putting pressure on those companies and making the office space even more expensive, forcing them to sell more than they actually would have wanted to.
Let's also move on now to Coca-Cola. They seem to have done super well. So we know that around the world, people won't smoke cigarettes as much as they used to. They won't drink alcohol as much as they used to, but they'll still have their Coca-Cola.
Yeah, so Coca-Cola is one of those consumer defensive companies which also always seems to do well. It's also one of our topics for 2024. They continue to generate strong cash flow, sustainable cash flow, and managed to grow their revenue organically by about 12% over the past year. So it's a really good company, and I think 2024 would be a good year for them with inflation coming down as well. They obviously feel input costs a lot more than companies like Microsoft or Google.
And speaking about Coca-Cola, I'd also like to touch on Heineken there. That's the Dutch brewer there and also a beer company. What are we seeing coming out of there? It looks like they are, expecting some sort of profit growth. But like I said, people just don't consume beer the way that they used to around the world.
That's true. The thing is, they also experience inflationary pressure, leading them to increase their prices. And being not being as defensive as a Coca-Cola, volumes obviously decreased. So volumes took a knock, and then obviously earnings took a knock as well. So that's the benefit of being a company like Coca-Cola. You could obviously increase prices to pass that inflation to the consumer.
Also keen to touch on Sony with you, Louis. Operating profit there jumping 10% in the third quarter. I'm not a gamer, but I'm always surprised at how much people are willing to spend on gaming.
Yeah, this was actually mostly due to, the bright spot in Sony is actually the financial services sector, and as well as the image sensor business. They sell a lot of those sensors to companies like Apple. The actual gaming hardware side of it, the forecast was worse than expected, obviously due to growth forecasts not being great for 2024.
Also interesting, I think the companies we've all spoken about today, Louis, they all rest on consumers, and all around the world, I think consumers have had to maybe take a step back, and look at their budgets as we see these interest rates increasing rather. And I'm wondering to get your thoughts here on what you have called defensive stocks here, and looking out for them as we stay in this higher for longer, period. If investors haven't gone in yet on those defensive counters, is now still a good time?
Should companies like Nestle or Coca-Cola, they feel input costs are rising, but obviously in a disinflationary environment, it's wonderful for their margins, and they tend to sell products that consumers need to buy anyway, even if the prices do go up and inflation is a worry. So we feel that even in a low growth environment, companies like Coca-Cola and Nestle should do well because it's a disinflationary environment as well. And then obviously one of our picks are also bonds, which do well in such environment as well.
Well, Louis, I'd like to talk about your stock pick in a bit, but first I'd like us to reflect on counters that have found favor with your industry peers.
So I'm picking ABSA. So I think that the next set of results, we're going to see the credit loss ratio start to improve, so less losses. But I think that the June was the peak of the cycle, the credit loss cycle. And then we're expecting interest rates to come down, inflation's a bit lower, wage growth hasn't been too bad, so there's a bit more added impetus to the economy, which means I think sort of 12 months out, the loan growth will be slightly better for the banks. And ABSA's been really hammered quite hard after Jason Quinn left. They didn't signal well to the market what was happening in their loan book in December, but they tried to rectify that with a call with the analysts and a trading update. So I think that this set of results maybe not that exciting, but I think the prospects for the group are quite good, and you really are not paying much for it. I mean, you're paying less than book value, 0.9 times book value. It's paying over 8% dividend yield, and you get a bit of earnings growth and a re-rating in the stock as well. So I think that it's a good time to buy it.
An Italian bank called UniCredit. It's one of the biggest Italian banks, and very similar to what Mark just explained. It's also a bank that they fixed their loan book. They're trading at 0.9 times book, but the ROEs are now substantially higher than the cost of equity. So that would imply you can justify a price to book ratio well in excess of the book value, not a discount. It's trading at a 6 PE and the dividend yield above 6%. And I think why European banking investors have got this misconception about the fair value of a lot of European banks is because rates have been so low. Like I said, since 2008, rates have been abnormally low. And you had some banking issues a year ago in the US. But the US banking system is very similar to Europe. In the US, a consumer can fix their home loan for 10 years. So the bank must take the risk. In Europe, like in South Africa, if the reference rate moves, you as the consumer needs to pay more. So the banks don't take that risk, the interest rate risk on long-term loans. So that is why I like the European banking sector, and I like UniCredit, cheap and good quality.
Depending on how this offshore market reacts in the coming sessions, I think you could see some nice opportunity there. But the one that I did choose was Curro. I think you got some numbers out last week. It looks like this business can grow 20+% from a headline earnings per share perspective for the next 2-3 years. And in a market where we're struggling a bit for growth, I think it's a nice opportunity. So Curro.
All right, Louis, keen to get your thoughts on some of those. ABSA, UniCredit, and Curro.
So ABSA, yeah, it's trading at very cheap valuations, good dividend yield. However, we remain cautious on SA banks. Obviously, the SA consumer is under a lot of pressure, and we could see loan losses be a bit higher than anticipated originally. So yeah, obviously, if they can contain any loan losses, it's a good company and it's a good dividend yield that one would get there. And then Curro, yeah, it's one of the better companies in South Africa at the moment. Most of their capex has been done, and they are increasing their return on equity every year, looking good and generating good revenue every year, good revenue growth at least.
And which stock are you loving today, Louis?
So it's basically themes. So it's reshoring, infrastructure, and defense. We feel that even in a low growth environment, many of these G7 countries indicated that spending on the following areas should be increased: the reshoring, green infrastructure, and defense. So companies exposed to these themes should do well regardless of the economic environment. So it's a bit of a defensive pick, and a pick that you probably won't find growing by 20 or 30% every year, but should be a solid, a couple of solid companies and maintaining good margins. Just a few examples is companies like BA Systems and Siemens.
Fantastic. It's always a pleasure having you with us, Louis. Have a great afternoon further. That was your Midday Markets Update with Louis Storm from Vega Capital.